welcome to Forex Money USA. I get it. For a lot of people, the idea of investing seems super intimidating, especially if you feel like you don't have a lot of cash to throw around. You might be thinking, investing? That's for people with thousands, even millions of dollars, right? Wrong. You don't need a fat stack of cash to get started. Today, we're going to blow that myth right out of the water and show you how to start investing with just $100 in the US stock market, one of the most accessible and potentially lucrative markets in the world. Yeah, you heard that right. Just one Benjamin Franklin? Whether you're a complete beginner or you've dabbled a bit in personal finance, this video is your roadmap to planting those financial seeds and watching your money grow. So buckle up, hit that thumbs up button, and let's dive in. All right, step one on our journey to financial freedom is setting up your brokerage account. Think of a brokerage account like your gateway to the stock market. It's the platform that allows you to buy and sell stocks, ETFs, and other investments. Now, the good news is that opening a brokerage account is way easier than it used to be, thanks to the rise of online platforms. There are a ton of great options out there, and many of them don't require a huge minimum investment. In fact, some popular platforms like Robinhood, Fidelity, and Charles Schwab let you get started with absolutely nothing. That's right, $0 to open an account. Now, when you're choosing a brokerage account, it's like picking the right pair of shoes. You want to find one that fits your needs and your investing style. If you're just starting out and want a super simple, user-friendly interface, Robinhood might be a good option. It's known for its commission-free trades, which means you can buy and sell stocks without paying any fees. If you're looking for more research tools, educational resources, and maybe even access to international markets, then platforms like Fidelity or Charles Schwab might be more up your alley. They've got a wider range of investment options and resources to help you make informed decisions. Don't stress too much about picking the absolute perfect brokerage right off the bat. The important thing is to just get started. You can always switch to a different platform later on if your needs change. Just remember, take your time, do your research, read reviews, and compare fees and features before you commit. Okay, so you've got your brokerage account all set up. Now let's talk about a game changer in the world of investing fractional shares. You see, back in the day, if you wanted to invest in a company like Amazon, you needed to shell out thousands of dollars for a single share. That's because Amazon's stock price has been sky high for years. But here's the thing, not everyone has thousands just lying around to drop on a single stock. That's where fractional shares come in. Fractional shares let you buy a portion of a share for, you guessed it, a fraction of the price. So instead of needing, say, $3,000 to buy one share of Amazon, you could buy a fraction of a share for $100 or even less. This is a total game changer because it opens up a world of investment opportunities, even if you're working with a smaller budget. Want to own a piece of Tesla even though their stock is pricey? Fractional shares. Have your eye on Google but don't want to break the bank? Fractional shares to the rescue. Now, not all brokerages offer fractional shares, so it's important to check if this is something they offer before you open an account. But many of the popular platforms like Robinhood and Fidelity have jumped on the fractional share bandwagon, making it easier than ever for investors of all levels to get in on the action. Just imagine, you could build a diversified portfolio with companies you believe in, all without needing a ton of cash up front. That's the power of fractional shares, my friends. It's like having your cake and eating it too. Except in this case, the cake is a delicious slice of the stock market. Chapter 3. Building a strong foundation with low-cost ETFs. So, we've covered opening a brokerage account and using fractional shares to invest in companies you love. Now let's talk about another powerful tool in your investing arsenal, low-cost exchange-traded funds, or ETFs for short. Think of ETFs like baskets of stocks that track a particular market index, sector, or theme. For example, one popular ETF is the SPDR S&P 500 ETF, often referred to by its ticker symbol SPY. This ETF tracks the S&P 500 index, which is made up of 500 of the largest publicly traded companies in the US. So when you invest in SPY, you're essentially investing in a tiny piece of all those companies with a single purchase. ETFs are a fantastic option for both beginner and experienced investors because they offer instant diversification. Instead of putting all your eggs in one basket by investing in just one or two individual stocks, ETFs allow you to spread your risk across hundreds, even thousands of companies. And the best part? Many ETFs have super low expense ratios, which are the annual fees charged by the fund managers. We're talking like 0.03% or even lower for some popular ETFs. That means for every $100 you invest, you're only paying a few cents in fees per year. That's practically free. Now, there are tons of different ETFs out there, each with its own investment objective and risk profile. You can find ETFs that focus on specific sectors like technology, healthcare, or energy. You can find ETFs that track international markets, emerging markets, and even bonds. The possibilities are nearly endless. Chapter 4. Mastering the Art of Dollar Cost Averaging. All right, now that you've got a handle on brokerage accounts, fractional shares, and ETFs, let's talk about a powerful investing strategy that can help you build wealth over time: dollar cost averaging. See, one of the biggest mistakes new investors make is trying to time the market, trying to buy low and sell high. But here's the thing, even the most experienced investors can't predict with certainty when the market will go up or down. It's like trying to catch a falling knife. You never know when it's going to bounce. That's where dollar cost averaging comes in. This strategy is all about taking the emotion out of investing and sticking to a consistent plan. Here's how it works. You invest a fixed amount of money at regular intervals, regardless of what the market is doing. So let's say you decide to invest $25 every week into the stock market. Some weeks the market might be up, and your $25 will buy you fewer shares. Other weeks the market might be down, and your $25 will buy you more shares. The beauty of dollar cost averaging is that it takes advantage of market fluctuations. When the market is down, you're buying shares at a discount. And when the market is up, those shares you bought at a lower price are now worth more. Over the long term, this strategy can help to smooth out your average cost per share and potentially boost your returns. Another benefit of dollar cost averaging is that it takes the pressure off trying to time the market perfectly. You don't need to stress about buying at the absolute bottom or selling at the absolute top. You simply stick to your plan, invest consistently, and let the power of compounding work its magic over time. Chapter 5. The Long Game: Patience and Consistency in Investing. We've covered a lot of ground today, from opening a brokerage account to exploring different investment options like fractional shares and ETFs. But here's the most important lesson of all. Successful investing is a marathon, not a sprint. It requires patience, discipline, and a long-term perspective. Look, I get it. We live in a world of instant gratification. We want everything fast food, fast internet, fast results. But when it comes to investing, trying to get rich quick is a recipe for disaster. The stock market is inherently volatile. It has its ups and downs, its bull markets and bear markets. There will be times when your portfolio is soaring and you feel like a financial genius. And there will be times when the market takes a dip and you question your every investment decision. But here's the key. Don't panic sell when the market dips. Remember, you're in this for the long haul. The stock market has historically trended upwards over time, even with its occasional hiccups. By staying invested, riding out the storms, and sticking to your investment plan, you give yourself the best chance of coming out ahead in the long run. Now, I know what you might be thinking. Graham, this all sounds great, but what if I need to access my money before retirement? What if I have an unexpected expense or a financial emergency? That's a valid concern, and it's important to be prepared. That's why it's crucial to build an emergency fund before you even think about investing. Your emergency fund is your financial safety net. It's there to cover unexpected expenses like medical bills, car repairs, or a sudden job loss. Aim to have 3 to 6 months worth of living expenses saved in a high-yield savings account that you can access easily if needed. Once you have your emergency fund in place, you can then focus on investing for the long term. Remember, time is your greatest asset when it comes to investing. The earlier you start, the more time your money has to grow and compound. Even if you can only invest a small amount each month, it can add up to a significant sum over time thanks to the power of compounding. Chapter 6. Start investing today. So, there you have it. You now have the knowledge and the tools to start investing with just $100. Remember, investing is not just for the wealthy, it's for everyone. By taking control of your finances, making smart investment decisions, and staying committed to your goals, you can build a brighter financial future for yourself. It doesn't matter if you're starting with $100 or $1,000. The most important step is to simply get started. Remember, the best time to plant a tree was 20 years ago. The second best time is today. So what are you waiting for? Take that first step towards financial freedom. Open a brokerage account, explore your investment options, and start building your portfolio. Trust me, your future self will thank you. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more tips on investing. Thanks for watching, and remember, it's never too early to start investing.